On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects. And SoFi, get your money right all in one app.
All right, welcome to the On the Tape podcast. I am Dan Nathan. I am joined, as always, by EY from SoFi. That would be Liz Young. Liz, welcome.
Buenos dias.
Liz, we got a lot to go through today. This is a big week in the markets. We have the Fed meeting on Wednesday. We have the all-important jobs reading for the April report on Friday. A whole host of earnings still to come. Some big tech names, a lot of consumer names, and the like. Big week in the stock market last week, which is kind of flying in the face of what went on the prior week. So we got a little bit of herky-jerky action there. We, of course, have to talk about what the yen is doing versus the dollar, maybe some intervention there today, and what you think the knock-on effects might be for our markets or global macro markets. But first, after that conversation, Guy and Caitlin Malin, the COO of iConnection, sat down with Peter Polanski. He's the senior managing partner at Orbra Capital. They had a whole heck of a lot to say about structured credit, the rate environment, how they see opportunities playing out in 2024. So stick around for that conversation. It was a great one. And also, tomorrow, this would be Tuesday at 1 p.m. Liz, Guy, and myself are going to be down at FactSet's Focus User Conference in Miami with a live market call that will be on our YouTube channel. So check that out. We got a big audience down there. We're really excited to be with our friends from FactSet. We're excited for Liz to be down there with us. All right, Liz, one thing before we get to the markets and all this stuff, I'm going to do a little Guy Adami here. What the heck happened to your Milwaukee Brewers? The Yankees ran roughshod over them in 2 days, Saturday and Sunday. They scored 15 runs a game. Huge differential there. Wasn't pretty.
Yeah, well, it's hard to score when you're not swinging the bat well. And 15, I mean, that's embarrassing.
Yeah.
I think maybe there should be a run rule, or even like a run rule for a series. Can we do a run rule for a series in the MLB where you can't beat a team by more than like double digit? I don't know.
Yeah, something like that.
Yeah, it was bad. Yeah, but I'm glad Guy's not here. And my Bucks lost yesterday.
Yeah.
Somebody got ejected for too many technicals.
Yeah.
It's just, I don't know. The wheels came off the Wisconsin sports bus over the weekend.
Well, we're still rooting for you, Liz. How's that? Okay. All right. So we got a big week here. And again, last week it was kind of interesting. In earnings land, there were some huge names that had some big moves lower and some huge names that had some big moves higher. And it's one of those periods, I think, where as we're getting to the tail end of earnings season, you got to come up with what like a narrative might be. You know what I mean? And so it's interesting. We've been tracking our main man, John Butter's work. He's a senior earnings insight analyst over there at FactSet. And we know this, that estimates come down into the quarter. So then you have this situation often where maybe expectations are lower than people, kind of thought they were at some point, and then you end up beating lowered expectations and the stocks rally a little bit. Thoughts on where we are in this earnings cycle right now? And does it give you greater confidence about the kind of where stocks are relative to the economy, or did you pick out some things that make you a bit more concerned?
Well, I think coming into this earnings season, first of all, we knew that this was not going to be the quarter that made all of 2024 positive, right? This was always going to be the one that was a little bit lackluster, low single digits at best. And it was the one where the Mag 7 or big tech needed to carry almost the whole thing. So that's why last week was such a big week. We had a handful of those big tech companies report. They needed to bring it home in order for the S&P earnings growth to stay positive for the quarter. For the most part, that still happened. So I don't think that there was any huge issue that happened, broadly in that sector. What is going to be interesting now is we've had the banks, we always have the banks first. Now we've had a lot of the Mag 7. There's obviously some stragglers that we'll still get from those big tech names. But this is the period where you start to hear from cyclical companies, you start to hear from consumer-based companies, retail, all of that will start to come in, and we'll get a read on other sectors of the economy. And at a time where the market had rallied so big and then had a really tough April in a lot of those areas, I think it's going to matter a lot. And I continue to say and continue to believe that first quarter earnings are not very much about the results of the first quarter. They are so much more about what companies are guiding, and if the guidance is as good as investors want it to be in order to justify these multiples, because the multiples still are at a level that, although not completely extended, not sending overbought signals, but they're frothy enough that they're at a level where we have to uphold fundamental strength, if not get better fundamental strength as the year continues, along with a pretty calm and benign macro environment, neither of which seems to be materializing right now.
Yeah, it was interesting to me, if I just want to pick out a few names a little bit, like when Meta was down, and I was on Fast Money, I think it was Thursday night, when the call was going on, and the stock had gapped down 10%, and at one point was down nearly 20%. Okay, this is, a $1.2 trillion market cap company. And just do the math on that, down 20%. And you know why? Because the spend was guided up about by $2 billion, okay, which was like a few percent or so. And then revenue growth in the quarter in the guidance that they were speaking to was down about $2 billion. And I just couldn't get my head around how $150 or $200 billion in market cap could come off of stock based on that. And then you have on the flip side of that, Google ends up 10% on, pretty decent numbers in a guide. And, again, if you're watching Market Call, that we've been positively, set up for that. And that was a matter of expectations, in my opinion. The big one for me was Microsoft, because Microsoft had sold off in sympathy the day before with Meta. But when they put up their quarter, the stock was up about a couple percent or so. And obviously, that's the largest market cap company in the world. So expectations were really high. That stock was showing really good relative strength. But let me tell you something. There is a quarter in 2024 for Microsoft when it probably doesn't look too different than what Meta just did, where the spend is a little high and revenue growth starts to decel, and you're going to have a lot of folks head for the door. So when you just mentioned the Mag 7, and we know it's really like the Fab 5 or something like that, because Tesla's gone, and I know Tesla's had a nice little rally since its earnings, but it also had fallen off a cliff in the weeks leading up to it. And Apple, we're going to get this week, hasn't really joined the party yet too. So I still think there's just this kind of over-reliance on the Mag or the Fab 5 or whatever you want to call it. And nothing that I saw so far leads me to believe that that's likely to change. And if anything, I really do believe that as we get closer to NVIDIA's earnings in the next few weeks, that we might honestly put a pin in this whole Fab 5 sort of situation. And it really will matter whether other sectors start to broaden out or not. Does that make some sense to you, Liz? Because nothing that I've seen so far, and again, we're going to get Apple and Amazon this week. I suspect one will probably outperform and maybe one underperforms. There's no clear narrative of those market leaders.
Well, I think there's two different things that you would be talking about in that. The first of which is that in periods where the market gets a little nervous, so let's call it for the first 3 weeks of April or first couple weeks of April, the market was pretty nervous, yields were rising. What happened was investors, I called it a little game of put the money back where it came from. So we got hurt in the cyclicals, we got hurt in small caps, and we put the money back into some of those Mag 7 stocks. I don't think that it was necessarily all because of sudden fundamental differences in the Mag 7 stocks. It was because that's what people had been used to, and that's what had performed well for them. That's what was there for them when they needed them before. So we're just going to put it back and say, okay, you know what? My muscle memory is that these stocks tend to do well no matter the environment. So now I'm a little spooked and I'm going to do that. So there's the market action and the momentum that's going to happen in the stock prices. But then the fundamental piece of it is what we're seeing this quarter and what I think you're alluding to for the rest of the year. What was really interesting to me, and Guy and I talked about this a little bit on Market Call last week, and I would welcome your thoughts on this, because I wonder what investors are really thinking, and is there a little bit of a tone shift? So Meta announced an increased spend, but it was an increased spend in AI. Remember back when they announced their increased spend in the metaverse, and it was this big thing, and the stock took a huge hit, took a few huge hits. That was largely because investors were looking at what the heck is the metaverse? What are you, we didn't even understand what that meant. And eventually the stock recovered, obviously. But here we are, they're going to increase their spend in AI. This isn't something that investors are looking at and saying, we don't know what you're talking about. Obviously, we know what AI is. And so far, companies had been rewarded for skewing towards AI. Is this a tone shift where suddenly we're talking about increasing spending when investors are actually looking for those big tech companies to stop being so spendy? Are we looking to reward them for tightening up the belt this time around? And has that tone shifted?
Yeah, no, that's a great point. And again, going back to 2021, the company also, this was Facebook at the time, renamed the company Meta, right? And talked about tens of $billions of spend that they were going to embark on, investing in and around a metaverse. People did not know what that was. They had this Oculus device. They know that it was very focused on virtual reality and gaming and the like here. But I think, you had to kind of buy into some pie in the sky thoughts about the future of computing at the time, and they weren't really able to articulate that. So, the stock sold off 75% from its highs in 2021 to its lows, I think in late 2022, which was pretty astounding if you think about it, because it was over $1 trillion in market cap then, I think, on its way to, a few hundred billion. I think this is different because the company has already been able to demonstrate how they are using generative AI in their own business, right? Which is creating a better experience for advertisers, for users and the like. And I think they're better at articulating what their vision for generative AI is going to be. They have this open source Llama model, which is getting very good reviews relative to, let's say, some of the stuff that OpenAI and some of these startups like Anthropic and the like have. So to me, I think it is different. I said to you, I was really surprised by how much that stock sold off, but I also think it comes back to expectations. This is a stock, I think, heading into the print was up 40% on the year or so. And a lot of folks were making an argument about how it's really cheap, and especially relative to some of the larger mega cap companies. I would make the argument, and I did on Fast Money that night, is like if you look at the out year, if you look at next year, 2025 earnings expectations, a meaningful deceleration, right, to kind of teens earnings growth and teens sales growth, and trading at 25 times or so, it's just not that cheap, especially if you believe that the company is going to be in this generative AI arms race. So that's how I squared the circle, but not down 20%. You know what I mean? Like if it was down 6 or 7%, I'd say fine, taking a little bit of that froth off. So I think you're asking the right question. And I really do think it comes down to NVIDIA again in a few weeks. If they speak to a greater deceleration in demand for their high-end generative AI chips, then every investor in all of these names is going to take another look and say, what should these be valued on? If, you know what I mean? If they've spent all this money and now we're starting to see the supplier having a meaningful deceleration. So that's my 2 cents. Does that make some sense to you?
It does. Well, and I also wonder how much of, if the company that's spending gets punished, is it the one that is going to benefit from the spending that'll get rewarded? And in this case, maybe that's what investors are doing. So the spending is not going to be rewarded, but the beneficiary of that spend, which could be NVIDIA or the semiconductor space in general, does get rewarded. I mean, we don't know the answer to that yet, but it's starting to look like the pieces are in place for that to be the trend.
Yeah, no doubt. And again, it was interesting that when Meta was down, opened down 11, 12%, that day, NVIDIA opened down also in sympathy, but then it was quickly on its way moving higher, and I think closed up, 6% on Friday, which I think is kind of interesting. Let's swing to the consumer really quickly here. You mentioned some of the earnings. Domino's today, McDonald's tomorrow, Amazon's the big one tomorrow. Starbucks will be really interesting. Coca-Cola, we had Pepsi last week, and some of the things that they had to say or, was evident in their ability to kind of pass through price increases. We also have MasterCard, which follows on what we heard from Visa last week. Apple on Thursday is going to be the big kahuna. The focus there is going to be China. But Liz, I quickly wanted to kind of hit, and I did this with you a couple weeks ago, a service that I really enjoy. It's called The Transcript, which runs through a lot of earnings transcripts and takes out some important quotes here. And this was about the consumer, and their headline for this, and we'll put it in the show notes, was pretty darn strong. The first quote they had was from Capital One. I think the U.S. consumer, this is the CEO speaking, remains a source of strength in the economy. The labor market remains strikingly resilient. Rising incomes have kept consumer debt servicing burdens relatively low by historical standards. This is from the Visa CFO. Consumer spend across all segments from low to high spend has remained relatively stable. Our data does not indicate very meaningful behavior change across consumer segments. This is from TransUnion. Consumer finances in the U.S. remained healthy due to low unemployment and real wage growth. Fiserv, at a macro level, consumer spending remains resilient. And lastly, from PepsiCo, I would say the consumer, this is the CEO speaking, globally, we think is very resilient, and we see it in, as you saw from our international business performance. So all of those together, pretty interesting stuff, Liz, across the board. You know, you're not hearing a level of caution that you might expect in this kind of rate environment, because sooner or later, aren't we going to be focused on the long and variable lags of tight monetary policy?
Oh my God. If I had a nickel for every time over the last 2 years that we've talked about the long and variable lags, if anything is certain, they are longer and more variable than we ever believed before.
Yes.
So, I mean, I don't even know why we bother anymore. And this transitory, everything is transitory. Life is transitory. Like maybe your definition of transitory is 7 years, right? So anyway, the thing about the consumer, and if Guy were here, he would say, never underestimate the consumer's desire to spend. That's still right. They still do have money. Here's an issue that I have, and I'm going to pivot on this a little bit because I think it's important to get to, and it irks me. This idea that is being floated out there that higher rates are stimulative to the economy and that the consumer is benefiting from higher rates because they're making so much in interest that they can just take that interest and go out to the store and spend it. Okay. And on some levels, for wealthy people, that may be the case. All right. You can get 5% in a zero risk investment and it's padding your account. I'm willing to bet, though, if you're a wealthy person, you're not clipping that out of your account, withdrawing it and taking that to the grocery store. So there's a mismatch in who we're actually talking about here. And the consumers that are going to feel it, or the consumers that are already feeling it, are not the ones that are getting 5% in a money market or in a treasury. So I don't think that it's stimulative to the economy. I think what it has done is elongated this cycle and made these lags longer and more variable. So I don't doubt that it's had an influence, or at least perhaps it's filled the gap between what we're hearing in the numbers of wage growth and inflation. But here's a stat after last week's PCE report. The 3-month annualized change for super core PCE, and as a reminder, super core is core services X shelter, so basically everything that's not a service and everything that's not a house. The 3-month annualized change is now at positive 5.5%. Okay. Now, there's a lot of different ways to measure inflation, but one of the things that the Fed does a lot is take those rolling averages. So take a 3 or a 6-month annualized change just to see where things are this quarter versus this quarter of last year. Up 5.5%. By my math, that is way above target. Okay. So it's not just about the point estimate that we're getting or the point data that we're getting in that particular month. If it's up 5.5%, that means that there is a big bunch of consumers that are feeling that pinch. And maybe they're still making ends meet. They're still spending, obviously. But we have already started to hear about trading down. So I think as we get results from some of these companies, McDonald's will be really interesting. And some of those ones that are on the lower end of the cost spectrum are the ones to listen to. This is when you listen to staples, right? Listen to companies that are telling you whether or not they have what they called organic growth, which was price pass-throughs last year, if that's still happening. And if it's not, how are they maintaining their margins? And what does the spend actually look like now that companies cannot pass through inflation anymore? And the last thing I'll say about this, sorry about the rambling, but the last thing I'll say about this is the stuff that we know is still going up in inflation. Copper's up a lot, right? Cocoa prices were up a lot. We still know that some food prices are up a lot. We've got services up a lot. You can't have a company like Coca-Cola, for example, come out and say, well, we're raising prices on soft drinks because copper is up, right? It just doesn't make sense anymore. And frankly, last time we got all the inflation data and CPI, sugar was down. So it has to make sense to consumers. And I think we know too much now as consumers to really be able to absorb some of those messages.
Yeah, it's interesting you mentioned McDonald's. Guys mentioned this a couple times over the last few weeks or so. They talked about a trade down. If you think about this stock is, sold off fairly precipitously since its January highs, right around it reported, last, and hasn't really gotten much back or so. And I just find that kind of interesting. So I really want to hear what they have to say. I also want to hear what Starbucks has to say, first because of those input costs, but then also China and the like. And, over the last 6 months or so, we've heard a lot from some of these sort of quick serve restaurants, both here and abroad. It's just some of the effects of some of the geopolitical stuff abroad and just the macro here. So, to me, those are pretty interesting. So we got to get back into away from earnings a little bit, back towards the Fed, and then obviously the jobs report. Let's talk about yields a little bit. If you think about the 10-year, it's at 4.63 right now. It was a little higher at some point last week. I think expectations are for Fed Chair Powell to be fairly hawkish when he speaks Wednesday afternoon. And again, I presume that he has a look at that April jobs report when he's speaking Wednesday afternoon. Obviously, he has no idea how the market is going to react to that. But when I look at the S&P 500 here, and again, it was, I think, up 2.7% or so last week, which is the best week of the year so far. We sold off into last week. So on the end, we had this nice little rally led by some of those big names. I look at the options market. It's pricing about 1.5% in either direction for this week. So we have some big earnings and we have these two, let's call them, economic sort of days, Wednesday and Friday. What's your take here heading into this? If the Fed chair is as hawkish as people expect him to be, and let's say the jobs number, let's just say it doesn't do anything to make you more dovish, you know what I mean? What do you think rates will do, and how do you think the stock market will react?
So first of all, the jobs number comes out on Friday. The way that the Fed has messaged it is that they only get a heads up about data that is going to be released while the meeting is in session. So it could be that we hear from them, no, we didn't know about the jobs data. That may be true. So that data would get released afterwards. I do think he's going to be hawkish. I think that he's going to be consistent with the way that he spoke a couple weeks ago, where he said, basically, we need more confidence than this. We don't have as much confidence as we did before in the idea that inflation is moving in a sustainable way towards target. So January and February data, they said, was within their expectations. I think March data threw them for a little bit of a loop, or at least gave them some trepidation about the idea that, okay, it's stickier than we thought. We got to keep holding here. I think all of the data continues to support the idea that they should just do nothing for a while. And the market is expecting that now. We've got the odds of a June cut down to 12%, July down to 33%, and September is even now below 75%. So the first full cut isn't even priced in until December at this point. We're just under 100% chance in November. So, and remember, if we make it to November, longest Fed pause ever. Okay. So that may be okay for markets, as markets tend to do okay in these in-between phases. But the more and more that approaches, and obviously if it lines up with an election, there's a lot going on that whole week. So I do think we're going to hear hawkish comments from him this week, because they need to continue to focus on inflation. The labor market, frankly, hasn't really been much to talk about. So there's nothing for them to focus on there in the comments, because there isn't any data that backs up any change of stance in labor. So I don't think that this week's labor market is suddenly going to show us something surprising that we haven't seen coming. But I do think over time, it will slowly deteriorate, or at least get cooler. And I think the really important thing for this year is not only going to be the data itself, but these mental thresholds that investors have. If the unemployment rate gets above 4%, even though that's still historically low, I think it's going to bug people. If we start adding consistently less than 200,000 jobs each month, even though that's still strong, I think it's going to bug people. So we've got these little thresholds that we're used to, that it'll be interesting if and when we cross them, what happens in the market. Yeah.
And going back to the stock market for a second here, it's kind of interesting that, if you just look at the performance, and this is, why we focus on those large names. I mean, the S&P is up nearly 7% on the year. I think at its highs, it was up maybe, 10, 11% or so. And if you look at the best performing sectors, communication services, we know it is in there. That is that kind of Fab 5, Mag 7, whatever you want to call them, is up, more than 10%. Energy, which is low single digits percentage of the S&P 500, 500 weighting is up 14%. And then you have financial services, which is also single digits weighting, it's up 8.5%. Those are really the only three sectors that are outperforming. The financial services one is kind of surprising to me just because, again, we thought the narrative was higher rates or higher for longer, bad for banks in general. We know in 2023, some of those big money center banks and the regionals had problems with their held to maturity mark-to-market situation with their treasury holdings and the like. So again, it just places a greater emphasis on the importance of those mega cap tech stocks. And at some point, I just feel like that if higher rates do cause the economy to slow down a bit, you're going to see enterprise spending slow down. And then, the valuations will be called in question. It's like, what are you willing to pay for these companies that are in an arms race to build these generative AI systems to launch across their platforms when there might not be demand for it? And at some point, that's to me how that kind of trade comes undone. But let's go back to as far as yields are concerned, because let's talk about this carry trade. Let's talk about what's going on with the JPY. The Japanese yen against the dollar reached 160. That was a 34-year level that had not been breached. The talk of the BOJ intervention. So now we have dollar yen at 156. So a huge reversal, huge volatility today. Talk to a U.S. investor, Liz. I know we've gone through this again and again, but we were all focused on that 150 level, then 155, and then 160, and it seems like that was the level in which the BOJ intervened. But again, I don't see anything going on in our market, and part of this has to do, we just went through this, is that if the Fed is going to remain hawkish, that means dollar strength, right? And so it leaves the Bank of Japan no other. It leaves the Bank of Japan in a really difficult spot. They either have to, intervene to prop up their currency or make a decision that maybe a weak currency is good for them for all intents and purposes. I don't know. But when will this affect our markets here? Because again, we started with the carry trade. That was something that a lot of U.S. money has been parked in for a very long time.
Mm-hmm. And just so those listening, you've probably heard the term carry trade if you don't know what it means. Frankly, during this environment, the carry trade is getting more and more attractive. The yen is getting weaker. So the idea is that you borrow in the lower yielding currency or the weaker currency, and then you invest in the stronger currency. So the carry trade for many years has been to borrow in yen, the weaker, and invest in dollars, the stronger. As this gap continues to widen, or at least stays wide, the carry trade is not necessarily under threat of unwinding or having people needing to so-called cover their shorts, right? So right now, it's still working. So that hasn't been really the biggest topic of discussion. Here's what could happen. This has not happened today. But you're right. We were looking at 152, then 153, all the way through the 150s, and 160 happened to be the moment where it seems like the Bank of Japan decided that's enough, or they cried mercy. I still have not found anything that tells me exactly what they did in order to support the yen, but it's very clear that right around the exact moment that the yen strengthened, the dollar did weaken. So there was clearly some kind of offsetting mechanism that occurred. As a U.S. investor, here's the most straightforward thing that could happen. If they continue to try to support the yen, one of the options they have is to dump U.S. treasuries. So in order to weaken the dollar in relation to the yen, what they need to do, first of all, is weaken the dollar. But the other thing they need to do is buy the yen. Well, in order to buy the yen, they need capital to do so. If they're holding a bunch of treasuries, in order to raise that capital, they can dump treasuries to do that, which would then push our yields up, theoretically, push our yields up even higher, completely independent from what's happening with inflation, completely independent from what's happening with whatever the Fed says. So it's another force. If we're worried about higher for longer, if we're worried about a spike in yields in the US, it's another force that could drive yields higher, completely outside of our control. The speculation, however, is that even if they do that, it's not going to work. Or maybe it works in the short term, but it's not going to last, because the reason that people buy dollars is because it's yielding more. It's more attractive. So if they push our yields up, all it does is make treasuries and dollars even more attractive. So then you get, what's the next effect? Okay, so then this becomes the global issue. If it doesn't work, if they continue to intervene in the yen and it doesn't work, the other option they have is to raise their own rates aggressively, but they're only at 0.1% right now. They've got a long way to go to get to somewhere even close to parity with some of the other major nations. If it doesn't work, what it could do, and what it's already been doing, is that the yen will weaken against all of the major currencies. So it's already been weakening against the Chinese yuan, right? China is a big trading partner of Japan. If there becomes an issue with that currency pair, China may try to intervene. And then you've got intervention coming from multiple places. You've got the yen weakening against all major currencies. And that is, now this is more of an Armageddon scenario. This is not what I'm saying would happen, but it's a possibility. That is the makings of a currency crisis. So that's sort of the further down the road, right? If none of this other stuff works, but that's why this is a story. In the near term, what you could see is a reaction in treasury yields in the US.
Yeah. And again, it's funny. Treasury yields, though, seem like kind of stuck here. I thought they would be kind of marching a bit faster in the face of this kind of hotter data and then what's going on, versus, let's call it, the Japanese yen and the Chinese yuan, but it hasn't happened yet. You know what I mean? So again, is there some piece of data out there that causes a spike up to 4.8, and then you kind of see a retest of that last year's high at 5%? And it's just interesting to me, though, that heading into earnings season, as rates were kind of headed higher, the thought was that at some point, whether it was 4.35, then it was 4.5, then it was 4.65, whether stocks would really care. And they did for a little bit. I think our peak to trough decline was maybe 4.5% in the S&P 500, but kind of holding in here. Let's see what happens as we get through most of earnings. And I think by the end of this week, we'll be through earnings, focused on the macro once again and yields and the like. So a lot going on this week, Liz. And you and I, we got a little travel between now and the Fed meeting. So I think we covered a lot of ground. Anything you want to leave the listener here with, what you're most focused on between earnings, the Fed, and let's say what's going on overseas with some of these currency pairs?
Well, Fed meetings, I say this every time. The Fed meeting is like my Super Bowl, and I get it multiple times a year. So that's what I'm focused on this week. But I think what's happened in April is that what has shifted is that the market became really short-termy again. And this is not a period where you're going to see markets, I think, investing or reacting for long-term investment opportunities. I think we're going to be hanging on and at the mercy of every single data point for a while, because there's still a pretty big difference between what the market wants the Fed to do and what the Fed continues to message that they're going to do. So then the data matters. Every single point matters to what's going to happen in a day-to-day market reaction. So this is more of a swing traders market, frankly, and I think the risk on trying to chase that around on a day-to-day basis is high, but I would, as an investor, sort of get used to the idea that we're going to see, I think, more and more whiplash until we get clarity on what happens with this rate cutting cycle and until we get all the way through earnings season. So buckle up.
Yeah, and just my 2 cents here is that I suspect that, whatever we get from earnings will generally be a wash. We're going to hear, some good stuff, some bad stuff on the spend, on demand, on all that sort of stuff. And it probably washes itself out this week. And the focus, I'm with you, will be the Fed and just how hawkish, the Fed Chair Powell is, and whether it moves rate cut odds out even further than where they are right now. And then it's just like, okay, how hot does the data continue to be? How desperate does the BOJ and let's say, the Chinese central bank, how desperate do they become to support their currencies and the like? So to me, that's the narrative that I think probably causes a retest of last week's lows in the S&P 500. And I do think it's happening. I think at some point we will have at least a 10% peak to trough decline this year. And I think the highs are in for a bit. I just, in my mind, can't kind of see a scenario, at least in the next few months, where we're going to be retesting those prior highs, because what I've heard from earnings and what I've heard from the Fed and what I see around the globe from a macro situation, nothing suggests that, we shouldn't be more cautious about what's to come relative to, let's just say, a continuation of some of the strong data. But again, who knows? All right, Liz Young, I appreciate it.
Wait, one more thing.
Yeah?
One more thing I want to remind people of, and I will not be surprised at all if Jerome Powell says this on Wednesday. He told us for months that they needed or expected a period of below trend growth in order to take care of the inflation problem. We just got our first GDP print that was below trend growth. I've said this before. I think the Fed's stamina and the Fed's threshold for pain will be much higher than the markets. The market doesn't like below trend growth. We saw that in the GDP reaction. The Fed, I think, will probably reiterate, we needed this to happen. This was the point. Right? That's why we raised rates, was for this effect. It took longer than we thought it would, but here we are. We wanted this. And I think that is something that the market might have a hard time digesting.
Yeah, I think that's a great point. And back in December, when the stock market started taking off, the Fed basically was expecting, I think, 1.4% GDP growth in 2024. They revised that higher, I think, by March to 2.1%. And so to your point, the fact that Q1 came in at 1.6%, a lot of stuff that I see is back half loaded, whether it be corporate earnings, whether it be, economic growth and the like. And again, to me, that's just not a great thing to be betting on. If the stock market is supposed to be a discounting mechanism, this is one of the reasons why you should maybe cause a little caution at the moment here, especially where equity valuations are. But again, we keep rolling on and rolling higher. All right. Stick around for Guy's conversation with Caitlin Malin, COO of iConnections, and Peter Polanski. He's a senior managing partner of Obra Capital. Liz, thanks so much. I'll see you down in Miami.
See ya.